The S&P 500 is up roughly 260% in the last 10 years. On the surface, that looks like strength. But underneath it, the market is getting dangerously narrow. The top 10 companies now make up roughly 40% of the entire index. So the fear makes sense. Everyone can feel the tension. Everyone is waiting for the bubble to pop. But the real question is not whether the market is stretched. The real question is, how much longer can this run continue? And is the crash actually happening now? When you pull back and look at 100 years of market data, the pattern points somewhere much later. The real crash window is not tomorrow, it is around 2033 to 2034. Here is the structure. Markets move in long technology cycles. After the Great Depression, the market launched a 24-year bull cycle powered by industrialization and electronics and automation. That run gained roughly 2,536% before it rolled into a long bear market. Then came the next cycle, from 1975 to 2000. Personal computers, the internet, and the digital economy drove a 25-year bull market that gained around 2,665% before the dot-com collapse. Now we are inside the third major cycle. It began after the 2009 bottom. First came e-commerce, then social media, then cloud computing, and now AI is the engine pulling the whole thing forward. If this cycle follows the previous two, then a 24 to 25-year bull market from 2009 gives you a peep around 2033 or 2034. That does not mean the ride is clean. There can still be brutal pullbacks. 20%, 30%, even 40%. But those are corrections. They are not the big one. The crash we are talking about is different. That is the kind of decline that takes years to recover from. Potentially 8 to 9 years, and drags the market back toward its long-term moving average. And yes, the AI bubble concern is real. A small group of companies is driving the rally. Some of them are doing circular deals with each other. AI spending is enormous compared to current revenue. That matters. But bubbles do not usually break just because everyone finally notices them. Sometimes they run much longer than people can emotionally tolerate. Then, there is crypto. If AI agents become part of the next economy, they are going to need transaction rails. Not old, slow, centralized systems built for humans clicking buttons. They will need infrastructure that can handle billions of automated transactions. That is where blockchain enters the picture. So the takeaway is simple: zoom out. Stay focused on the long-term cycle. AI and crypto are the center of this final phase. And until that larger structure breaks, short-term fear is mostly noise.